For the first time on Wednesday, the Fed mentioned the pivot.
Appropriate at some point to pause rate hikes.
But they still mention rates are not effective.
And a sizable portion of the economy is yet to respond to the rate hikes.
But consumers are pulling back.
They're pulling back on housing. They're pulling back on things like furniture. They're pulling back on goods spending.
And on Friday, retail sales touched zero for the second time this year. But it didn't matter because inflation missed expectations.
Let's recap. We got September CPI up 8.2% year over year. That was hotter than 8.1 expected. Core CPI was on fire.
All-time high. Well, it accelerated.
It's actually getting faster.
It's getting worse.
But the RSI and the VIX screamed oversold and the market bounced.
So why did we bounce today? The VIX measures events 30 days out and probabilities.
So the market bounced because higher than expected inflation brings certainty to the Fed's next rate decision.
There are three events that matter in the next 30 days. The CPI, the November 2nd Fed meeting, and then the election. All of a sudden, right now, we got two of these data points probably taken out. We now know what the CPI is, and we now all know that the Fed's going to do 75 basis points.
Okay, expect 4% Fed funds rate, but does core inflation come down in November?
What's being reflected in inflation right now is shelter. Shelter costs are apparently high according to CPI.
Hey, at least energy and food came down.
But if you look at Realtor.com or Redfin, rents are actually slowing down.
So real-time rents are coming down.
The scary thing is that shelter is about a third of CPI, and what rent measures is people that are already in leases. It doesn't show what new rents are being signed for. So that's going to take a while for itself to work its way through CPI. So inflation can stay high for longer than we probably think.
Good point, but all the housing data suggests prices are moving lower.
Look at the housing market. You've caused a crash of unprecedented proportions in the housing market. The economy is breaking hard.
Okay, housing should come down. What about wage inflation?
Wages just increased at the highest level since 1980, and that's the sticky part.
Wages did explode, but that was in 2021. Ever since, wage growth declined, and stickiness depends on the employment rate.
If unemployment would just creep up a little bit and job creation would creep down a little bit, there would be a sense that they're getting closer to the end.
Basically, we have to root for bad news now.
Unfortunately, good news is bad news. And when you got the unemployment rate ticking lower and the labor participation rate ticking higher, it's bad news for the market.
We want layoffs. We want to get to 4.5% unemployment. We think that's more reasonable. Okay, so that's 1.1 million, 1.2 million jobs lost. How fast do you need to bring that about? You need to bring that about this month?
Job creation has to slow down. Unemployment is going to have to creep up.
The market wants to see job openings ticking lower, payrolls ticking lower, and jobless claims ticking higher, and that's what we're starting to see.
If you know that earnings are coming down, why would you want to be invested?
Because this is what opportunity looks like. Be greedy when others are fearful.
There's only 15 times since 1926 the S&P has been down 20% or more.
If the market can't hold the 200 weekly moving average, then it probably comes back down to the pre-COVID highs, somewhere around 340, which will give us another RSI oversold signal on the weekly chart.
If you're going to see a real move, durable move higher in equities, you got to get the dollar lower. That's going to give a boost to risk assets abroad and some more risky corners of Europe and Asia, right? Maybe back to at least 109 is the first test of support on the DXY.
If you're buying oil from the Saudis, you need dollars. If you're buying soybeans from Brazil, you need dollars. If you're buying copper from Australia, you need dollars. Now, as interest rates increase, the dollar strengthens, sucking in global liquidity and pushing down markets. So if you're looking for a bottom in stocks or crypto, you really need three things. You need the dollar to peak, the Fed to pivot, and the bottom of the ISM PMI survey. 100% of the time, when the survey drops below 50, the Fed either cuts or pauses rates. Now, of course, this could change, but producer prices lead inflation and they're going lower, and commodities lead producer prices and they're going lower. And that leaves us with the unemployment rate. Bad news is good news. Where's it headed?